What's up, everybody? Welcome back to another episode of Cash Flow Conversations. I'm super excited. I have a really good friend on the show today, Devin Burr, and he goes by Mr. Burr on social media. You might have heard of him, a kind of famous infinite banking professional who's pretty successful in his own right with real estate properties and things like that. And today we're going to talk about how to utilize other people's money, talk about infinite banking, talk about, as we always do, how an entrepreneur goes from a W-2 and safety into this 1099 world of investing in yourself. So Devin, welcome to the show, dude. It's good to have you here.
Man, great to be here. Thanks for the gracious introduction. I appreciate it. So I will try my best to live up to everything you said. So thank you very much.
Absolutely,
Appreciate it.
man. I mean, you got what, 1 million followers on social media now?
Yeah, like 1.1, which is just kind of crazy. I have to pinch myself sometimes, thinking that many people actually care what I say,
Yeah, it's
because
crazy.
it wasn't always like that.
Yeah, that's phenomenal, man. So let's go with your background, dude. We were talking a little earlier. You were saying that you kind of started off in the mortgage industry when you were in college. So, what year in college were you? Junior when you started doing mortgages?
Freshman. So I was 20 years old, just turned 20. It was 2005, and got into the mortgage industry because I worked with some people that had started in that industry, and they're like, "Dude, we're crushing it. We're making so much money." So I'm like, "All right, I'll try it out." But I was going to school part time. I was in ASU, and then I got my first commission check, and it was $10,000. So I'm thinking, like, why am I going to school? Because I knew like the average like person that graduates college and all this, like the average income was about 50 grand. I think that's what it was.
Yeah.
And that's, I think, for the household back then. So I'm thinking I just made 10 grand in 1 month. Why am I going to go to school? This is dumb. So I dropped out and just was in mortgages. And anyone who knows mortgages back then, it was not like what it is today. It was the wild, wild west. And I remember I started, and my manager, he plops down like this mortgages 101 book on my desk, calculator, and a whiteout pen. And I'm like, all right, the book makes sense. I got to learn mortgages. Calculator makes sense because I got to calculate them. What's the whiteout pen for? He's like, you will find out. So it was very, very dicey back then. That's
What
for
was it
sure.
for?
So let's say you need a certain amount of income to
Yeah.
qualify for a loan, your debt to income ratio.
Yeah.
So you send in your documents for your income, and your income doesn't qualify. You white out that income and you write in what you need. That's what the industry was back then. Cutting out people's signatures, taping them onto places, and putting them through the copier, like calling up appraisers and saying, "Hey, I need the value to be this. We can't do that." Okay, hang up. Call the next appraiser. Hey, I need the value to be this. We can't do it. Hang up. Call the next one. I need it to be this. You got me? Cool. I'll send a lot more business your way. It was Dude, it was the wild, wild west. It was insane.
Dude, I remember that because I was in college uh, for architecture, and the average architect getting out of college is going to make like 35, 40,000.
Mm.
And my brother who didn't finish college, was in the mortgage industry, and he worked for this. I won't say the name, but he worked for a company that like went out of business. They just shut their doors because of all that. But back in the day, dude, he was cranking. These guys were cranking out loans, making money hand over fist. Shame on us for not being 10 years older and being able to take advantage of it back then, you know?
I'll tell you what, though, man, like I'm a firm believer now that your integrity is everything. I want to last. I don't want to be one of those companies that is crushing but doing it the wrong way so the doors close. Like that's how it was for me. I worked for AmeriQuest. I remember that was like where I started in '05. I came to work one day and there was locks on the doors. Like we could not get in.
Same story
Um,
that my brother had, dude. They're all just standing in the parking lot looking at each other.
yeah,
They just
dude, it
shut the
was
doors.
it was grimy. So I actually got out of mortgages. I want to say like '07 because I just
Yeah.
felt bad about what I was doing. I was making really good money. I was 20 years old. I was still living at home with my mom, no bills, and I'm making like 10 to 20 grand a month. So Wasn't even 21 yet. I had a fake ID. I would go to clubs and get bottle service and like just wiling out at 20 years old and blowing every penny I made. It was, and then I just felt bad about like I'm putting people in these loans that they can't afford. So I was kind of adding to the problem, obviously, that happened in '08. And
Yeah.
I got out of it in '07 and just jumped around job to job and just trying to find my place in the world, for a long time, actually, until um, like 2016.
Wow. You had some years. You were doing some fitness stuff back then, though, weren't you?
Yeah, I was just trying to find myself, man. I was very insecure. I was, I didn't know who I was. And I think a lot of people go through that in their early years. They're just searching for themselves. And I was in a lot of pain, right? Just, I was getting my heart broken all the time by women. I had gotten addicted to some things early on in life, just different drugs. And I was going down a really dark path trying to like just hide and like hide the pain basically. I don't know. So part of my thing was let me just get really really jacked and dialed so that I felt good about myself because inside I didn't. So I really started hitting the weights hard. I got down to like 3% body fat, started doing men's physique shows. I got fifth place in the nation in one show, which was
Wow.
crazy. Um, and inside though, man, I was still just lost and in pain and hurting because I didn't know who I was. You know what I mean? So,
I totally get it.
um,
But, when in a world that's uncontrollable, you can't control what's going on. You can control how you look. And
yeah,
you took control over what you put in your body and the way that you were presenting yourself to other people.
yeah. That I'll tell you this though, dude, like it's probably one of the best things I ever did because the amount of discipline you have to get in that kind of shape, it it spilled over to everything else in my life. So like literally to get down to 3% body fat, most people think you just have to take steroids. That is not the case. If you take steroids and you're not dialed in on your diet, dialed in on working out, dialed in on sleep, you are not going to look good. You're probably going to look kind of just puffy and almost like fat, but
Yeah.
really strong, right? So
Yeah.
I learned discipline through what I put in my body. I learned discipline from getting up early and going to the gym, going when I didn't want to go, not going out and drinking with friends because liquid calories were the worst. So it actually built a lot of discipline in me that I now use in like my business life, and it's helped a lot actually. Just that one thing, and that started back in 2014.
Wow. Okay. So 2014, you're in great shape. What are you doing for work?
So 2014, I'd gotten back into mortgages in 2010. So I left '07 to 2010. I jumped around. I can't even tell you how many jobs, man. Just a ridiculous amount of jobs. And then I got back into mortgages because everyone told me like, dude, everything's regulated now. All that shady stuff doesn't happen anymore.
No more
So I
ninja
got
loans.
Yeah, so I got back into it and it was not shady anymore. So I was doing well again from like 2010 to 2013. And then I was thinking the grass is greener somewhere else. I started working at Quicken Loans.
Yeah.
Um, doing great. Worked my way up and thinking the grass is greener, I go to a different company. And then I started jumping around from company to company again. The grass was not greener. The grass is greener where you water it. So I basically just jumped around for 3 years from mortgage company to mortgage company. And yeah, I came back to Quicken in 2016. So while I was doing my whole fitness thing, I was lost again. I was actually becoming very broke because the money I was used to making, the lifestyle I had, I wasn't making that anymore, jumping around from job to job trying to find another place. So
Hmm.
that was part of why I got into the whole fitness thing because I was so lost, man. I tried to go back to Quicken, they wouldn't let me back. It was a rough 3 years, that's for sure.
And then, so how did you find infinite banking?
Man, so that would be fast forwarded to like 2020.
Wow, that recent.
Yeah, so Basically, what happened was I was back at Quicken Loans. They actually ended up taking me back in 2016. I met my wife there in 2016. She was new. I saw her. I swooped her up before anyone else could, which was good because she was getting like flowers sent to her at the office from
Oh,
different.
dude.
Dude, when some talent came in at Quicken Loans, everyone was like vultures, man.
Well, you got a bunch
So
of type A people in that office too, so they're not shy to go reach out.
exactly. So I made sure I scooped her up first. So yeah, she started crushing it there. She actually still works there, and she's like one of the top bankers in the entire company.
Wow.
She crushes it. She was doing way better than me. And 2019, when we got married in March, I just started really being unsatisfied with what was going on. I was making like six figures every year, but I started realizing like the more you make, the more they take, right? The government. So it's bracket creep. The more you're making, the more they're taking in taxes. You're not making really as much. Putting money into a 401k, I started realizing like this is so dumb. I'm not going to have access to this money for 30 something years.
Yeah.
Um, I started saving some money, but I'm like, man, this isn't for me. I'm not a good employee. I've jumped around a million jobs. I realized every time someone told me to do something, I'm like, screw you. I'm doing it my way. I just realized I have to be the owner of my own destiny. I have to just leave and start my own thing.
Yeah.
So since she was doing really well and our bills were very, very low, I'm like, can I leave? Are you comfortable with that? Me going and trying to build something. Are you comfortable with me not making a little bit of money for a while? She said, absolutely. So I quit the next day. It was October 8th of 2019. And I started doing, of 2019, I started doing real estate full time. And I was crushing it, dude. From January when I got my first deal till March when the pandemic hit,
Yeah.
I did 8 real estate deals, some wholesaling, some flipping, all with zero marketing. I didn't spend $1. I
Wow.
would just go to like local events, and I'm a very social person. I just like being around people. So I would get deals from just networking. And COVID hit and all the meetups went away. So I'm sitting in my house like everyone else on lockdown, and I'm like, I gotta improve. I have to do something. So I've read a bunch of books. I got a bunch of books on my bookshelf back here. I started listening to podcasts. And I heard a podcast with Chris Noggle talking about becoming the bank. And I was like, that makes so much freaking sense.
Yeah.
I got to learn more. So I started getting books on that. Read R. Nelson Nash, Becoming Your Own Banker. I read Caleb Williams, The And Asset. What Would the Rockefellers Do by Garrett Gunderson. I just got obsessed with this concept. And then I reached out to Chris on instant messages on Instagram
God
or
bless
direct
social media.
messages. Yeah, I just hit him up. I'm like, dude, I saw you on this podcast or heard you on this podcast. Would love to get a policy. How can I do it? So got a policy with him. First one was May of 2020. By the end of 2020, I've got 4 policies. I'm using them for all my real estate. I was putting in at that point $300,000 a year. Um, and then it just took off, man. I was using it, so I understood the concept. I just started telling everyone. I think when inherently as humans, when we see something funny, when we learn something cool, when we do something cool, we want to share it with other people. We don't want to just have it all to ourselves. So
Yeah.
I was telling everybody. And then someone told me, Ricky Morgan, shout out to Ricky Morgan if you ever watched this, homie of mine in Arizona. We were in a mastermind. He's like, dude, why don't you just get on TikTok and tell people about these policies that you're doing? And I'm in my mind, TikTok was just my daughter doing her little dances at the time. So I'm
Yeah.
like, that's dumb. Why would I do that? And he's like, no, dude, it's very educational. The platform's kind of shifting. Get on there and talk about it. I'm like, cool. I did it. One video I put about how to buy cars using policies. Went to bed, and the next morning I had like 20,000 followers. I was like, this is nuts. and it went
Wow.
gangbusters from there. So it's been crazy ever since.
Well, shout out to you for no one. You didn't do it because you knew it was going to be successful, right? TikTok, it was just like, why would I do this? But let's go try it. And you don't know the outcome that you're going to actually get until you actually start trying.
Right.
No one would expect you to have 20,000 followers after one video. So how many followers now on TikTok?
Like 870,000, something like that.
Wow. So you kind of figured out the formula too, like on how to make a video that can capture somebody's attention and create some engagement.
Yeah. So what I did on TikTok, man, is I was a student of it first because I saw the power of just me not really trying and just making a video, and it went crazy. So I'm like, there's got to be something to this. So I started looking up different people that talk about real estate or finance or whatever, and I started seeing what they were doing, the things they were doing that went viral. So I'm like, I just studied it, different elements that they were using. I'm like, I can do that, and then just talk about infinite banking. So that's what I did. And no inclination whatsoever of like monetizing that. I was
Yeah.
just thinking, I want to get this out to people. I want to help people with this because it was helping me tremendously. I was
Yeah.
bankrupt in 2016. I had $300 to my name before I met my wife, a month before I met my wife. Um, and end of 2020, I'm a millionaire at that point. Um, that year, I think I was on pace to make like 400 grand. And this was the first year being like a business owner. So I was going to keep more of the money because of tax write offs and such. Infinite banking was a huge part of like that growth. So I'm like, I just need to share this. And then it got to a point, dude, after probably I'd say 2 months. So around February, I had 300 and something thousand followers. Everyone's asking me, like, dude, how do I do it? I want to do infinite banking. I want a policy. So I'm just thinking, yeah, go to Chris Noggle. I was sending everyone to
Oh
Chris
no.
Noggle.
Shout out to
Dude,
Chris. He loved that.
he was loving me, dude. He's just like, I'm probably sending daily 30, 40 new clients that are just ready to go.
Was he like,
And
dude, you got to get licensed?
no, no. So he's probably just like, he's like, yeah, I'm just sending him business. And behind the scenes, he's probably just like, this guy is amazing. I love this guy. So it hit me probably like a week and a half in of sending that many people. I'm thinking like, wait a second. Like these people are learning from me. I'm basically selling the policy and then just teeing him up to set it up.
Yeah.
Like if I'm doing the work, shouldn't I be getting the benefit? So why don't I just become Chris? So I got licensed March of 21, and to date I've set up I think 1,700 policies, some along those lines, all
Bro,
from social media.
that is absolutely incredible. Most agents aren't doing 50 policies in a year. So
It's
you have a pretty good team behind you. Chris has a pretty good team there at what's the company called?
so we go through the money multiplier. And yeah, I just plugged into that team. So I've got a team built in. I don't have to go hire people. I just bring leads in. Um, I don't even take the calls really anymore. I'll take overflow calls, but basically the team will take the calls. I'm bringing in the leads, and I'll just break them off with some of the commission. So it's a beautiful thing, man. It's just been to the point where I can start growing different sectors of what I want to do. Private lending. I do a lot of equity deals, private equity deals now. Just building different relationships instead of just being on the phones all the time. My first year, the first year I wrote like 700 policies, and it was all me.
What's the
So,
average size of a policy for someone to get started?
I'd say the average size for it to really be beneficial, like you could start a policy for like $50 a month, but it'd be anemic. I'd
Yeah.
say probably for it to be a beneficial is like 10,000 a year.
Yeah.
Cause you figure, let's say you put in $100 a month.
Yeah.
What are you going to do with $100 a month? You know, it's going to take a long time to get enough cash value to really start using it for infinite banking. But if you drop 10 grand in, you'll have access to anywhere from like 6 to 9,000 bucks right away. So you can do a lot of stuff with that. You can start paying off some credit cards, whatever the payments were on those credit cards. Instead of paying those card companies, you're paying yourself back, your policy. So now you're getting the interest that you used to send off to them. And we all know credit card companies are super high interest. So I think that's kind of the sweet spot to start, right around 10 grand. More you put in, the better, though.
Yeah, and some of these policies are super flexible where you could do first year dump in straight to cash. So
Yep.
you could throw in 30 and then keep 10 grand a year going forward.
Yeah. I do that a lot. I tell people if they just have extra money sitting around to do a dump in, because if you think about infinite banking is all based around compound interest. A policy, a life insurance policy, is guaranteed to compound 100% tax free as long as you don't overfund it too much. So think about that. Compound interest just takes two things: time and consistency. So the more time you give it, the bigger it becomes. So shouldn't you front load it? Shouldn't you put in as much as you can today? Right. So just, I tell people, if you got 100 grand, put all 100 grand in there. That's $100,000 compounding for you for the rest of your life. And then can you do 100 grand a year? No. Okay. Let's do less per year. But that's the consistency part, time consistency. So if you can only do 50 grand a year, 40, 30, whatever it is, put that in every year, because then you're giving consistency behind the time factor, and then compound interest along with unhindered control. That's the huge thing. Having control of that money. That's what makes infinite banking amazing, is uninterrupted compounding and unhindered control.
I love it, dude. That is so important because at the end of the day, life insurance is not an investment,
Correct.
it's insurance. And
Correct.
if I realize how that compounding works, I can eliminate banks from my life. And that's the idea behind infinite banking, really. It's not get rich quick. It's let's understand, let's have a long view of the playing field. And I know what I'm going to buy cars. I know I'm going to do investments. I want to get into real estate. I want to get into business, M&A kind of things down the road. How can I set myself up to succeed? And it starts with understanding compounding and control.
I tell people, yeah, it's one of the same things I say. It's not get rich quick, it's get rich for sure.
Yeah.
Because think about it, the average American, they lose, I forget the exact amount, I think it's 35 cents out of every after tax dollar to interest alone. So think about this. You make a dollar, you pay your taxes. So let's say the average person keeps 60 cents. After tax dollars, you're losing 35 cents of that just to interest. So if you can simply not lose that money to interest, you keep it because you plug that hole where you're losing it to banks, you're going to become wealthy and rich over time by just simply not losing money. And
Yeah.
that money, if you don't lose it, guess what it does? It compounds for you for the rest of your life. So it's not get rich quick, it's get rich for sure if you use the concept correctly.
Yeah. Yeah. I love that, dude. I talk to people about not getting rich quick, but making sure you're never going to go broke.
Yeah.
Because is the stock market going to do better than an insurance policy? Probably until it doesn't. And if it
Yeah.
doesn't in the year that you want to use the money, now you're out of luck. I have so many clients in their 60s going, the market's down. I can't sell. I can't take money out because the market's down. Okay, then how do you know it's down? Based on what? How much have you put in? They have no clue.
Yeah.
It's
Most
just
people
put
have
money
no idea,
somewhere and
man.
cross your fingers.
Most people have no idea how their money is growing, or I think the financial system is so broken. It is so broken, and
Well,
it's,
it's broken for a reason. It's not an
yep.
accident that it's
Yeah, there's
broken.
there's some people pulling strings, right? And it's just, the biggest problem in America is not what people don't know, it's what people think they know that just ain't so. And that's Will Rogers' quote. And it's so true because most people think they know that put your money into an index, put your money into a mutual fund, like save for the long haul, like all these things that we're taught. We think that's how money works. It's not. It's a complete lie that we've been fed to further agendas, basically, right? But
Yeah.
once you actually know what is going on, what's actually happening, you know what to do.
Yeah.
And you are the best steward of your money. If you give your money up to someone else, you're giving up control. And ask any wealthy person, any person that has built significant wealth, they will tell you that the number one thing they had was control, whether it's control of a real estate deal, control of a company, control of their money, whatever it is. Control is what is the biggest factor. When you do a 401k, an IRA, all these things that people think are the right move, you're giving up control of your dollars today when they're worth the most.
Hmm.
Inflation devalues them every day. You're going to have access to them later when they're worth less. You're not paying taxes today when you know what taxes are to pay taxes in the future when you have no idea. They could be way higher.
Yeah. And you're hoping
So,
that the account's going to be larger.
yeah. So you're going to pay taxes on the harvest instead of on the seed.
Yeah.
Like we're just taught things so backward, and most people they just have this blindfold on, and once they take it off, at least my clients, once I help them take that blindfold off and they're like, this is how it works, like why did I not know about this
Get that all the
15,
time.
20 years ago? And it's like, because it's designed that way. You're not supposed to know about it,
If the
you know.
banks, yeah, if the banks taught you how to never use them, they'd go out of business.
Right.
So why would they ever teach you how to not use the bank? If the financial industry couldn't charge you fees, they wouldn't promote what they're promoting. They're legally allowed to charge fees on pre-taxed dollars, knowing that you're going to put money into an account you've never paid taxes on. You're going to pay taxes eventually, but I get to charge you a fee to manage money that you've never paid tax on. By the way, I know you're not going to pull it out until you're 60. And then when you do go to pull it out, I'm going to tell you don't pull out too much because you have that bracket creep. You're going to start being a higher tax bracket, so don't take out too much. So I know, and I now have an asset. It's called a book of business as a financial advisor. I'm not a financial advisor, but as a book of business managing pre-taxed accounts, I get paid every quarter. I'm creating cash flow off of your retirement account, and you aren't enjoying the money. Of course, the financial industry is going to push that product because they get rich off of it. Wall Street loves it, the advising industry loves it, and then the IRS loves it because now, as the account grows, you have to pay the tax on the whole thing. A few years ago, if I inherited an IRA, I could roll it into an IRA of my own. Now, if mom and dad die and I inherit their IRA, I have to pull the money out over 10 years on top of my own income. So
Yep.
when I talk to people like, oh, so are your kids successful? Oh, they're very successful. Are they kind of successful? Or are they really? Oh, they're very successful. They make a lot of money. They do so well. Okay, so when you don't spend your IRA or your 401k and you pass that on to your very successful kids, they're going to pay taxes on top of their own income on everything that you leave them. The industry doesn't teach cash flow. They're not teaching spending money. They're saying save it. And here's the part that I love. The goal is not asset value. Think about that. The goal is not the asset value. The goal is the cash flow that can be produced from that asset.
Yeah.
And the industry doesn't talk about that.
The cash flow is what it's all about. We could dive into that all day long, man, because like I have become obsessed with taking money from policies and creating cash flowing assets out of them. Because a policy is an asset. It can be
Mm-hmm.
used as such. Like I've qualified for mortgages by using my cash value as an
Well,
asset.
let's talk about it really quick. Make that point because banks recognize cash value as an asset. They
Right.
will lend against the cash value. They will not lend against my IRA or 401k.
Right.
Why? Because the market's volatile. And two, I haven't paid taxes. The bank knows that's a fake dollar amount inside that IRA,
Right.
but your advisor's not going to tell you that. So the bank will recognize your cash value. So that's how you go. You're talking about doing cash flow deals.
Yeah. And the thing is, too, the bank loves it because guess what? The bank invests most of their tier one assets in
IRAs.
IRAs, right? No, high cash value, whole life insurance. And guys, I'm not blowing smoke. You can do your research if you want. It's called BOLI, BOLI, bank owned life insurance. It's so funny because every single time you go into a bank, notice how many vice presidents there are. Everyone's a vice president at the bank, right? Well, the bank has to have an insurable body. They can't just get insurance. It's a bank, right?
Right.
So what do? They get insurance on a VP, and part of their promotion to being a VP, a key person at the bank, is they give them a fully paid up life insurance policy. They say, Matt, great news, man. You have been crushing it as a teller. We are going to promote you to VP of tellers. And now, because of that, we're going to give you a fully paid up life insurance policy. You don't got to put any money into it. And if you pass away, your wife is going to get $50,000. How much is that policy actually worth?
A lot more.
3, 4, 5, 6, $10 million?
Yeah.
And all they're doing is they're taking tier one assets, so money that comes in, they're putting it into life insurance policies because they understand the power of them. The money never stops growing. It's liquid. They can use it for whatever they want. So they'll pay Matt's, let's say his benefits, right? They'll
Yeah.
pay him from the policy. So there's, guys, life insurance, once you understand how it actually works and if it's structured properly, it is the Swiss Army knife of finances. It really is.
And you literally can Google these companies like Bank of America, Chase, how much cash value they have in their policies. You can also see how much money they put
Billions.
inside the market. Bank of America, last I saw, was like 24, $25 billion in cash value.
Yeah, guys, they own more life insurance than all of the buildings and land combined. And think
Wow.
about that. Like, banks don't have like crappy buildings. When's the last time you went into a bank and you're like, this place is like run down and they're nice buildings. They don't have them on like not desirable real estate. They're on corners.
Dude,
So that's,
downtown, big talk. My friend of mine, Mark Tomei, who we talked a couple weeks ago, he talks about, you ever wonder why banks have all the big buildings and we have all the little buildings?
yeah.
Because, and they're not going to teach you how they do it. So here's a great point too. When banks lend money, are they lending their own?
No.
They're using other people's money, but that's against what, Dave Ramsey says.
Yeah. So think about this. I tell people this. This is like what always kind of has the aha moment for people is when you put your money in the bank, does it sit there? Most people know, like, no, they lend it out,
Yeah,
right?
yeah,
Most people know that. As Americans, we're trained to think a loan, because of the Dave Ramseys and the Susie Ormans of the world, we're taught to believe loans are bad. Like debt is bad. That's bad. No, no, don't get that. Because then you got to pay interest to somebody else. That's bad.
yeah.
But think about this. Banks, it's the most profitable industry or business there is because there's not a single bank in the nation that makes less than 400 to 1300% on the money that we place on deposit. Because think
And
about this.
they're the ones getting bailed out by the government, making a 400, 500% rate of return.
So here's what they do, guys. You put your money on deposit. They view that deposit as a liability because they have to pay you interest. Basic economics 101, right? A liability takes money out of your pocket, an asset puts money in your pocket. So they view your deposit as a liability. In order for it to become an asset, they have to turn it into loans. They view loans as assets.
Mm-hmm.
So they'll take your money, they pay you, let's say, easy math, they pay you 1%. Banks don't pay 1%, but let's just say they do. They pay you 1%. Now they take your money and they lend it out at, let's say, 4%. Okay. So they're lending your money. They make 4, they pay you 1. Most people would say, yeah, they made 3%. That's not accurate. They only paid you 1%. They used your money to make 4%. So they turned 1 into 4. That's a net return of 3, right? So that's
Mm-hmm.
a 300% return by using your money, not theirs. So
Wow.
if you can reframe your mind to think of a loan can become an asset. If I put my money into a policy, it's guaranteed to grow, and then I can borrow against it. So I get a loan from the insurance company's general funds. My money's the collateral to get that loan. So I don't touch my money. It's compounding and growing tax free. I've got this borrowed money now. I have to pay the insurance company interest to borrow their money. But if I can take it and go make more, it just became an asset. So if I borrow at 5, that's generally what the borrowing rate is. And I know without a doubt, I can lend money all day long at 15% interest.
Hard money loans.
So, yep. So private money, I just lend it out all day long. So if I can borrow at 5, take it and lend it at 15, I just made a 200% return cash on cash by using the insurance company's money. And the entire time, my money's still compounding and growing. And if that's the case, which it is, it's contractually guaranteed. That means that this pile of money keeps getting bigger. So, what can I do every single year guaranteed? I can borrow more. I have more that I can borrow. So, I have more capability of loans.
Yeah.
I can become the bank and just do what they do, turn loans into assets. And as soon as people reframe their mind to think a loan is not a bad thing, it can be an asset if it's used properly. Infinite banking is absolutely incredible.
I love it, man. So structurally, how do you structure a policy? So there's like variable universal life, there's indexed universal life or IUL, there's universal life, there's whole life insurance. What do you recommend? What kind of policies?
I don't recommend any universal product ever for infinite banking because I think those should be more or less for like a retirement account.
Okay.
Um, I don't like them for infinite banking for a couple reasons. One, the creator of the concept, R. Nelson Nash, he created the concept. He straight up said a universal life should not be used for this concept. So if the creator of it says it shouldn't be used, I'm pretty sure I shouldn't use it. That's one thing. Second thing is an IUL or a VUL, what it is at its core, it's a life insurance policy based on a 1 year annual renewable term insurance paired with an investment. You're pairing investment with insurance. That should never happen, in my opinion. Insurance is insurance. That's
Yeah.
what it should be.
Yeah.
It shouldn't be an investment. An IUL, a VUL, it's trying to make the two together. So that's something I don't like. So there's inherent risk when you have an investment. Insurance, there's no risk, right?
No
So
volatility.
yeah. And because of this, because it's annual renewable term, that means that every year you have to renew the insurance portion. What happens to us as human beings? We get older every single year. No one has figured out how to rewind the clock. As you get older, you get closer to your inevitable death. No one lives forever. As you get closer to that death, you are a riskier investment for the insurance company. So your cost of insurance exponentially grows the older you get. That's why I don't like these products because if you're using them for infinite banking, you're using the money. You're constantly taking it as a loan and deploying it to make more, or deploying it to buy cars, deploying it to do whatever. If your cost of insurance keeps going up and there's no guaranteed growth, which these policies have like a floor where you can't lose money, let's say the floor is 0. If there's no growth in the year because the stock market didn't do anything, the indexes didn't do anything, they went down, but you
Last
are
year.
at 0,
Yeah.
how's all your cost, your fees, which your fees are not fixed, your fees can adjust? How are they paid? They're paid
The
from your
cost of
cash
insurance. So
value.
that's called COI. The cost of insurance comes out
Yeah.
of that cash value that supposedly has a floor.
And if you don't have cash value because it's out deployed, what do you have to do to not lapse your policy? You got to put more money in.
And I worked with a client, they were like 73 or 74, and they had to come up with like $300,000 just so they wouldn't lose their universal life insurance. And if they did, it was going to create a taxable event on money that doesn't even exist because
Oh,
it's all loaned out, but there was growth, and it would have been a taxable event. So the son ended up helping him out and paying for it, which is the good news. But that's why I don't like universal really, even for
oh,
retirees, because it erode that cost of insurance erodes that fictitious cash value that you have.
it's if it's going to be used for anything, I think retirement
Insurance
should be the only thing. And even
insurance
then, yeah,
companies insurance companies are smart. They know how to not lose money. Devin, if you owned an insurance company, do you want to pay a death benefit?
if I owned one, no.
No, you don't want to pay a death benefit. So they're gonna find a way to make money on all of this. And so here's the part that I think is beautiful too. Universal life insurance is profitable to the insurance company because it's that renewable term that has to get paid. The client, the consumer, is taking the risk, trying to chase the market. Whole life is based on the profitability of the insurance company, which includes the profits from selling universal life insurance.
Yep.
So the more agents that sell universal life, it's like, great, it's profitable. That's going to help my dividend. That's guaranteed never to go down, where the cost of insurance can't go up, where I can have it paid up in X amount of years and I never have to put more money in. Guaranteed, I have no cost. It can't blow up when I'm 70 years old. So
100%.
I love the universal policies because it helps my policies at the end of the day.
It's the same thing with term, man. Like
Yeah,
most think about guys, think about this logically. If you owned a company, what would you advertise the most?
the
What
most
makes you
profitable product.
yeah, so like what's advertised the most out there? Term
Term by
insurance.
term. Yeah.
And what do people talk about? If you think about Dave Ramsey, buy term, invest the difference. Did you know that Dave Ramsey actually has a deal with an insurance company where he gets paid off of them doing term insurance? Why do you think he says
No.
that? So
Really?
it's insane, guys. Like here's the actual facts. If you get a term policy, most people get term around the time they have like kids. Average age is probably around 30, let's say. So you get a kid and you're thinking, man, I got to protect this kid and my wife in case I pass away. So 30 years old, you get a term insurance policy for, let's say, 20 years. The insurance company knows the likelihood you're going to die before 50, it's very slim. So the cost of insurance is very little. You pay little, very little. For 20 years, you're paying into that policy and you outlive it 99% of the time. Only 1% of the time does a person die during the term. So now you're 50 and you want to get 20 more years of coverage at the same exact amount. Let's say $1 million death benefit. You're now way more likely to die. The insurance company knows that. So to get you the same exact coverage, it's like 5, 6, 7 times more expensive per month for you. You can't afford it anymore at that time. The insurance companies are so smart. They they advertise that because it's the most profitable. So that's why people don't know about whole life. They don't do whole life. They don't do overfunded
It's
whole life.
because they say it's people say it's expensive. Whole life is expensive. And
Yeah.
to that I say relative to what? Because
Yeah.
me putting 20 grand into a government controlled asset called a 401k is pretty darn expensive. I don't even know how much is mine. So
Right.
if I'm going to spend 20 grand on something, the 20 grand is the same amount of money. It's expensive in the 401, it's expensive in a car, it's expensive in my life insurance.
Right.
It's the same dollar amount. But at least with the insurance I know exactly what I'm going to get and I have the access. So it's expensive relative to what? Because what are the odds? Think about this. If you buy term insurance when you're 30, and it expires and you end up getting what you want out of life, you live a long, healthy life. Your coverage is gone. The money is gone. The insurance company was profitable. It helps my whole life because I profit off of that. But if you don't die while you're working, what are the odds of you dying after you're done working? If I don't die while I'm working, what are the odds of dying in retirement at some point?
It goes up,
It's
right?
100%. I'm gonna die. And so when we buy a term policy, I own term insurance because I have little girls. I want them to be taken care of. But that's not the strategy. The strategy is to use my money over and over like a bank. So if I don't die before retirement, thank God, I'm going to die in retirement. I have whole life that's guaranteed to replenish all of this net worth that I'm going to spend and use to grow my assets while I'm having fun.
Do you know the crazy part about what we do? Is a lot of people say like, here's what we do, guys. Basically, in a nutshell, we set up whole life insurance policies by lowering the death benefit. So we're lowering the cost. We're lowering the commissions because that's what we get paid off of. Your death benefit. The higher the death benefit, the higher the commissions.
Yep.
Higher the cost. So we lower that death benefit as much as possible and then have you overfund it as much as possible up to what's called the MEC line, MEC. Basically, that's if you go over, it's taxable. So we're having you lower the death benefit, overfund it as much as possible without it becoming taxable. All that overfunding, very, very little commission, and that's where you get your cash value. So essentially, what we're doing is we're giving you money now to use and a death benefit on the side. That's not what's highlighted, but you get one. Some people say like, yeah, like I like being able to use my money. That's great, but I want to make sure my family's taken care of. I want a death benefit. Here's the cool thing. The way they are set up is the dividends that are earned from the insurance company being profitable, again because of all the term and IULs and all this stuff. That dividend is going towards paying for more overfunding, paid up additions. So what happens is when that dividend buys more paid up additions, you get more cash value. You also get a little bit more death benefit. So as that happens throughout your entire life, guess what happens? Cash value keeps rising, but so does the death benefit. I've got a policy. My first one I started, the death benefit's like 7.6 million. That's what it started at. When I'm likely to die, in my opinion, with AI and like my level of income, like I might outlive the endowment age of 121.
Yeah.
But let's just say average life expectancy right now is 80. Let's say I die at 80. The death benefit at that point is like 21 million. And I was able to use all the money while I was alive. So I got my cake and I got to eat it too. And
Wow.
by God, if you got a cake, why the heck wouldn't you want to eat it?
Exactly. I love it, man. Congratulations, Devin. You've had a hell of a career coming from the mortgage industry to helping people how to actually create their own bank. Um, what's your handle on all the socials?
It's Mr. So MR underscore Burr. So basically, what you see here, you might not be able to see this other R. There it goes. But it's underscore. So Mr. underscore Burr on all social media platforms.
BRRRR. So there's four R's in that.
Yep.
Nice, dude. Well, thank you so much for joining us, man. You do great stuff for the insurance industry and for your clients. 1,700 policies is an incredible number. People don't do that in an entire career, and you managed to do that in a few years.
It's been insane, man. I'll kind of leave people with this, I guess, and I wish someone would have told me this earlier on in my life. Is figure out like something that like just you kind of have some sort of passion in, something that just really you can obsess over. Get really, really good at it. Get so good at it that like it's undeniable how much you know, and then just start sharing. Share, 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 share. I read this book called The Go Giver. Um, everyone should read that book because the more you give, the more you get. And I lived a pretty mediocre life up until I was 35 years old. Pretty mediocre. I became successful, most people's standards, making six figures a year, but like it was mediocre. It wasn't unspecial.
Yeah.
The last few years have been insane. I've become extremely wealthy. I have lots of cool cars. I go on really cool trips. I never worry about money. And it's because I've helped 1,700 people. That's the thing. The only reason I could help that many people is because I became more valuable. I worked on myself. Here's what I can tell you guys. Work on yourself as much as possible. Once you become really, really valuable, money follows value. If you want to make more money, you have to become more valuable and just help more people. More people you help, more money you make.
I want to point out a couple of things you said. To help people, number one, you don't need money. You need effort. So put in effort. Number two, taking care of yourself allows you, when people say you're lucky, what a slap in the face to all the hard work that they never saw. You were
Yep.
prepared. When you found the infinite banking method, you were prepared mentally, physically to help share that message. And it took no dollar amount. There's no marketing dollars in that. You were prepared. So there's no such thing as luck. It's opportunity meets preparation.
Yep.
And three, you had the guts to just go do it without knowing what was going to happen.
Yep.
So kudos. Before we leave, what kind of watch you wearing, brother?
This is a just a little date just Rolex blue face. I freaking love this watch. Kind of hard to tell
What?
it's blue, but
That is beautiful. Okay, really quick, for anybody that says, why would you spend 10 grand on a watch? What would you respond?
oh, well, guys, what I do is I've got 13 infinite banking policies. That's how many I own. So I buy everything with policies. Technically, if you look at numbers, I make money buying this watch because instead of financing it from someone else, I borrow against my policy. I turn that policy, that loan into an asset by buying a watch this watch, I bought it at retail because I have a connection. This watch I could probably sell for about 20,000 bucks. So
And
right
retail,
there,
it was what?
retail it was 11.5.
Yeah.
So right there, I could make probably 9 grand off this watch. So already it's an asset. It's worth more than what I bought it for. But I bought it from a policy. So I took 11.5 from my policy, bought the watch. Most people, they're going to either pay cash or they're going to get a loan. If someone pays cash, that $11,500, it can never make them money again. It's called opportunity cost. If I spend 11.5 on the watch, I've got the watch. I don't have the cash anymore. Remember, my policy's 11.5 isn't used. So that 11.5 will continue to grow for the rest of my life. The 11.5 I used is a loan from the insurance company. I'm using their money. I'm basically getting an advance of my
Yeah.
future death benefit.
Yep.
So I take that 11.5, I buy the watch. Now, most people, again, they're going to use cash or get a loan. Since I'm not using my cash, what am I doing? I'm getting a loan. If I would have got that loan from someone else, let's say on a credit card or a personal loan, whatever, I'd have to pay that lender interest every single month. So since I'm the bank, I'm just paying myself back structured payments for this watch back into my policy. So I'm injecting more into my policy. That money's continuing to grow. The 11.5 is continuing to grow over time. I'm injecting more than 11.5 because I'm injecting the principal plus interest, but I used 11.5 too. So my net injection into my policy is less than how much it grows by. I technically make money by buying this watch, and it's worth more than what I bought it for.
Okay, so that
It's
was pretty good. But the insurance company is going to charge you an interest rate.
correct. So that's all factored in. That's all factored in. So they're charging me an interest rate, which is simple interest. Remember, policies compound on interest. So that 11.5 is compounding over time. So it's getting bigger. Interest making interest. The 11.5 I borrow, since I'm making structured payments towards it to lower that balance, it's simple interest. So every single month I make a payment on my watch back to my policy, which I then have access to the money again. The balance is going down, so I'm paying less interest. I'm accruing less interest to the insurance company over time, while my 11.5 keeps gaining more interest over time. So I forget the exact numbers. I have to run them again, but I think just by buying the watch, just from what I told you guys, my net injection into my policy compared to how much it grows, I think it's like $6,000 difference. So I technically make 6 grand by simply buying a watch. And then it's also worth about double of what I paid for it.
Yeah,
It's a
because
no
you didn't
brainer.
buy a liability.
No brainer.
Yeah, that's beautiful, brother. We might have you back on and explain that. We'll put a link to your website in the comment in the description below too. So if anybody wants to get a hold of you, they can do that in the description.
Yeah, if you guys want to get a hold of me, super easy. Just DM me on Instagram. That's probably my most active platform, and I don't have somebody else responding for me. I actually take the time and I respond. So if I don't get back to you super quick, it's because of that. But like generally I don't have things going like over a week. I'm catching up because I get on the Stairmaster every morning and I'm on there for like an hour, and that's when I'm just firing through DMs and stuff. So hit me up on DMs. I'll get back to you guys and more than happy to serve you any way I can.
Love it, Devin. Thank you so much for hanging out today, bro.
Of course, brother. Appreciate you.
All right, man. We'll talk to you soon.